Hello friends, Namaste. Welcome all of you to my channel. Today let's discuss about NAS 04, which is all about Nepal accounting standard on inventories. Normally we follow the difference book. It could be textbook, yeah, reference book, but it's always good to interact with the students. What about the Nepal accounting standard? Because I'm talking about the students who are studying the financial accounting. They have to study the different component of the financial statements, and one of the important component of the current asset is the inventory. So let's discuss about the Nepal accounting standard, what it tells about the term inventory related key terms, friends, and some of the approaches I would be discussing too. Now in this content you could see that is the it tells about the scope, objective, scope, definitions, and measurement of the inventories, cost of inventories, and some of the important formulas, and that's net realizable value and recognition as an expenses. And what about the compliance as for international accounting standard, that is I is missing here. Okay friends, now let's move to the it's the main part, that is it talks about the is objective part, because once you value the ending inventory, then you have to understand the some of the key terms. For example, look at this term, that is the I would just highlighted this one. This is the work in progress. As you know that in the like manufacturing company we have a different forms of inventory, like it could be raw materials, it could be work in progress, or sometimes we see that work in process, and last one is the finished goods. The work in process is the you could say that once you is the process of converting the raw materials into finished goods, and that before finished goods is the part of work in progress, where we would like to add value to the product that we are expected to produce, friends. Okay, now it's all about related to even the service contract, because we normally receive the order and accordingly we try to produce and supply to the market, friends. And next one is the financial instrument. Financial instruments, that's could be your equity, it could be like your derivatives, bond, commodities, like that. And next one is that biological assets. For example, if you are a farmer, then you would be dealing with the agriculture activity, and yeah, you try to produce the agriculture products. Then that is why that will be the biological assets. That is also the assets you have to report it in the balance sheet. And this is all about your procedural part. It talks about the commodity, broker trader, like that. And next one is that let's move to the some of the definition. I'm just talking about some of the key terms here to save your important time as well. Now definition is as we say that inventories is the stock of goods which is held for either for the selling purpose, or sometime manufacturing point of view. You would be manufacturing such a product and you would be selling. That means manufacturer could be also the seller. That is why inventory is all about. It could be for the manufacturing inventory, like your raw materials, work in process, finished goods. And for merchandise inventory could be like you would be dealing with the just finished goods only. Okay, you would be resale purpose for. Okay, now next one is that is very interesting, that is the net realizable value. That is all about your estimated selling price in ordinary course of business less estimated cost of the completion, and estimated cost, that's to make for the sale. So you have to present in your financial statements, that is the net realizable value. I will be discussing in detail also. Then that is why we say that when we say that cost of inventory, friends, in terms of your measurement of inventory, you could find it. Cost of inventory could be like your, it could be like a purchase, cost of purchase. There might be the cost of conversion and other cost too, like your in it could be like your you purchase the inventory and bringing the inventories to your present location. For example, your factory at Semra, for example, then you import inventory. Yeah, you purchase inventory from India, and then the bringing the inventories to your location of the Simra, then all the cost associated with the your inventory will be the part of invent. That's inventory cost, friends. So that is why we say that it could be also the part of like your purchase price. Similarly, import duty. Like if we talk about the international trade context, like you know that like Donald Trump, president of US, announced that from April 2, there will be the reciprocal tariff US government would be applying. Then in that case, how it would affect import, that's other story. But anyway, your import duty would be high, I mean to say that. And other taxes too will be the part of your that's the cost of purchase. And next one is that cost of conversion. That is the, it could be variable cost, it could be fixed cost as well. Like in variable cost, we change as per level of output, while fixed cost remain the same, fixed production cost. So you have to be careful while managing the cost. Okay. Now next one is that allocation of the, that is the fixed overhead. That means allocation of overhead is that how you are going to allocate your fixed cost in the, as per your policy, friends. That's the production policy. Yeah, you try to, you manage your overall cost situation. And next one is that is interesting, that's the normal capacity. Suppose you purchase a plant for production purpose, and if that plant is not your normally used, then in that case that may not be good for the company. So we talk about the normal capacity, because normally it has a normal capacity. And sometime during like a season, seasonality effect would be there will be a big demand. Then in that case we have to sometime produce more to meet the customer demand, so that there will be no any stock out situation for your company. Okay. Then other cost could be, friends, that is the like your cost of inventories, only to the extent that they are incurred in bringing the inventory to your present location, as I discussed earlier. Like it may be appropriate to include the non production overhead cost of designing products for a specific customer in the cost of inventories. However, some of the costs you are not going to include, by the way. Like your example of cost excluded from the cost of inventories could be like your abnormal amount of wastage, like materials, labor, and overhead, storage cost, then other administrative expenses. And even though you are not going to include the selling, yeah, marketing expenses while valuing ending inventory. That is the point you need to understand here. Even though you are given this data in your question set, you are not going to consider this one. Okay. Now next one is that is the cost of inventory of a service provider. Like your service provider could be like a airlines industry. Yeah, you can say that BFI. For example, when you are selling the merchandise inventory, then there is a attached service is also there. That is why there might be the service cost also that you need to consider here. Then cost formula, that if you remember, we have a different approach under the periodic system, like your a specific identification method, then similarly FIFO method, LIFO method, and weighted average cost method. You could apply whatever you learned from the books. Then but important point is that, friends, when you are going to like you save your tax, then in that case probably you would be using LIFO method, because LIFO method would provide you the cost saving. Okay, cost saving in terms of I'm talking about your tax saving, because of your additional expenses resulted from the additional because of more expenses in the LIFO method. Okay, and that would save your tax, but during the period of inflation. Okay. Now what about the net realizable value? That is the simply the cost of inventory may not be recoverable if those inventories are damaged. That it means, suppose you purchase the inventory, but because of some reason it your inventory damaged, then that could not be recoverable. But at the same time, they have wholly or partially obsolete, because for example, if we talk about the pharmaceutical company, if you are unable to sell, yeah, supply to the market, and then in that case that medicine could be obsolete, then you have to just destroy that medicine. So recoverable is all about what amount you could realize after selling it. That is the point that you need to understand. Yeah, that is, if selling price have declined, then again that will impact your net realizable value. Okay, now that is why we say that inventories are usually down, written down to the net realizable value on the item basis, right? Net, that is written down. You can't say that whatever you purchase the inventory at price, that will be the same. No, it will be the different. Okay, then which is also known as, sometimes we say that fair value or book value. Okay, sometimes we say that a carrying value, and that's why we have to estimate even the net realizable value based on the more reliable evidences, based on your estimates of your real data. Yeah, it could be also based on your projections. Then this NAS04 talks about so many key terms. I'm just explaining the some of the key points here only, friends, and believe that you have to review all this document clearly so that you would have a better understanding here. Now, financial statement being the part of inventory is also the part of financial statement. Then at the same time you need to review the accounting policy, right, to measure the inventories in detail. And what about the carrying amount of inventories? That is the book value, we see that. Okay, then similarly, what about the what type of expenses could be the part of the inventory purchase, that you need to understand here. Similarly, friends, it talks about so many things like your carrying amount of inventories places as a security for the liability. Sometime in your factory you may not have adequate finance. Then in that case, what we do, we just use our carrying amount of inventory, that is the book value of the inventories, which could be places as a security for liability, that is also known as working capital loan, so that you could meet your financing needs. Okay, then that's, and next one is that at the same time we need to compliance with the international standard too, that is the NAS. Okay, then I believe that whatever I discussed today, friends, it would clarify, it might have, it might clarify your concept also. So I would suggest to review in detail and update your learning process, friends. Okay, friends, these are the things that I would like to share today. If you like this content, please like, subscribe, and also share my channel. Thank you all of you for watching this video. Please take care all of you. Thank you.